Good morning, everybody, wherever you are. Welcome to the Economist virtual event that's focusing on the resilience of the financial sector after COVID-19. My name's Joan Hoey, and I'm the Director for Europe at the Economist Intelligence Unit. We have three excellent panels of speakers this morning to talk to us about the subject matter, and we've got plenty of time for discussion after the speeches. The event is being transmitted live on our YouTube channel. That's the Economist Southeast Europe events, and I encourage everyone listening to submit your questions via this channel. So this event will look in detail at the risks posed to the European banking sector by the COVID-19 crisis. And this will be the subject matter of the first two sessions in particular. But we will also consider the changes and potential opportunities that may be accelerated by this crisis. And that will be the focus mainly of the final session. Just before I introduce our two speakers for the first panel, just to set the scene a little bit, I will say a few words about what this crisis means for Europe's banking sector. The crisis does revive risks to the region's banking system because of deep recession. We're forecasting a recession of 8.4% in 2020 in the Eurozone. This recession and the inevitable associated rise in business failures will exacerbate the banking sector's problems of low profitability and high sovereign exposure. The problem of the doom loop, that's the mutually reinforcing link between sovereign and banking sector risk, remains because banks have increased exposure to domestic sovereign debt now compared even with 2010. In the last few months, policymakers have sought to protect the banking system from shortfalls in liquidity and have eased regulatory conditions to reduce losses. But there's a substantial risk to bank and sovereign balance sheets from the coming recession. One positive point, the European banking system was more stable going into the coronavirus pandemic than it was in the aftermath of the Eurozone crisis. NPLs were falling, Tier 1 capital ratios, that's stockpiles of excess capital within all banks, had increased, and the return on equity for Europe's banks, which is a broad measure of profitability, was also increasing. Also importantly, the establishment of the European Banking Authority has provided a unified banking supervisor across the euro area. And there's also a unified regulatory framework, albeit still in development, for European banks. But structural problems persist in specific countries in particular, particularly Italy and Germany, where bank return on equity and Tier 1 capital ratios are among the lowest in the euro area, and market concentration is far below that in neighbouring countries, which leaves smaller banks vulnerable to a reduction in economic activity. Now, I've already mentioned the European Banking Authority, and I'm delighted that we're joined this morning for our first panel by Jose Manuel Camper, who is the chairman of the European Banking Authority. And Mr. Camper is going to speak first and will be followed by George Zavos, Deputy Minister of Finance in charge of the financial system of Greece. So let me, without further ado, introduce Mr. Camper. Good morning, and thank you very much for joining us.